Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Okay, so we'll move forward here, and let's talk about initiating a repair strategy, because ultimately, again, we may at some point enter into an opportunity, and it's going to take us on a roller coaster ride. One easy way, of course, to participate in these FX options pair values is just to trade your directional bias using a simple call or a put. Now, of course, again, you can initially establish a spread strategy, whether it's a bull call spread, bear put spread, or so on or so forth. But you can trade your bias using a straight call or a straight put on its own. And I find that the benefit of using just a straight call or a straight put, of course, is always that limited risk exposure by the amount that you've paid for the premium. We're never letting that option premium expire worthless as it starts to go against us. We have a 50% rule on that initially, and so if it starts to go against us, and again, that's not placing 50% of our account into one opportunity. That's taking a very specific amount, no more than 10%, adding it into that, putting it into that opportunity, and then the first chance that we have to move our stop, we're going to do that. But the fact is that when we use a straight put or a straight call, we have an unlimited upside potential, but we're able to manage the downside risk exposure. So our job, of course, is to manage our risk and protect our capital. First and foremost, as traders, that's ultimately what we need to be doing. A lot of people enter into this business, and it's all about making money. It's all about how much can I make? What's my percentage gain? But realistically, your job is to be a risk manager first and to protect your capital, because if you don't protect your capital, you're not going to be in business for very long. So if you feel that at some point you're on the wrong side, but you're confident in the trade that you've positioned yourself in, then you can actually initiate a repair strategy in order to stay with that trade. Now, what I mean is what we can do is we can actually create, in this case we're going to be using a call option trade, but we can create a vertical spread and reposition ourselves at a lower strike price just by manipulating some of our positions and understanding some of the ins and outs of using options. So let's look at an example here. Now this is our EUI chart. And this is based on yesterday. So we've had a little bit of we're basically trading up into roughly in and around the same areas where we were trading at yesterday when I took this snapshot. But you'll notice here that the MACD has crossed over. So one may consider that we might be starting to enter into a bit of an uptrend here. And of course, again, I'm just surmising that if you're holding fast to that rule of a pivot point break, you can see that, in establishing a support level here, you can see that we've had a pivot point break. So what we've done here is we've established an entry point, and we've also established a support level here where if our anticipation is that if we do happen to get a break below that, then high probability we're going to start to trade down into some of these lower levels. But while we're in this trade, that is more or less your line in the sand. But recognize, of course, that as the market pulls back, it's going to take you on a little bit of a detour, and your option premium, if you've purchased a call option, is going to start decreasing in value as the underlying pair value begins to drop. So the idea, of course, is that what we can do is we can create do what we call a roll-down strategy. Now, the one thing that I just want to emphasize here is that what we've done is we've taken yesterday's pricing opportunity for our option contract, and then we've used our option calculator to essentially adjust for time and for the pair value depreciation in terms of a change in the underlying. And so obviously actual quotes during the day are going to vary. But what I want to do is I just want to get this across as an example, just to show you the logistics of how you might go in and look at creating this position. So first of all, we talked about creating an original position with, in this case, EUI at 75.20. That was the price that I was looking at yesterday. Now, what I did is I suggested earlier on that we want to take advantage of an option contract that is trading in and around the same pair value, or controlling the pair value at a similar strike price. So in this case, we were looking at a 75.50 strike, and we're looking at a June expiration. So this gives us out until June to participate in this opportunity. Now, the price per contract yesterday was $3 per contract. Of course, 100 I'll call them shares, multiplier of 100 means that that actual contract is going to cost us $300. And let's just, again, we're anticipating that we've been in the trade for a couple of weeks, and recognize, of course, that the time value component of our option premium is depreciating, but at the same time, we're looking at a pullback down to 72.5, which is roughly our support level. Now, we said that we had that line in the sand, recognizing that if EUI holds at that support, there is the possibility that it may turn around and move in the direction that we've anticipated. So rather than cutting our losses, right away, we can look to actually reposition ourselves to conceivably at least get our money back, or at the very least, or at least get our money back, or even make a slight profit. So our original position, based on that, the 2 weeks passing and that drop in the pair value, would be theoretically worth $1.65. All right, so that 75.5 strike would have lost just over, or just under 50% of its value, because we've had a significant drop in that in the EUI pair value. So what we want to do here is we want to reposition ourselves at a lower strike, recognizing, of course, that if we buy a strike price of $75.50 and we pay $3 for that option contract, our break-even point on expiration for that trade is the $75.50 plus our option premium. So in other words, for us to break even on expiration the third Friday of June, EUI has to be at 78.5 or 78.50 for us just to break even. So in order for us to make sure that we're managing our risk effectively, understanding where that stock has to be, or sorry, where that the pair value has to be, we can reposition at a lower strike and lower our break-even point. So at that point, we look out to our 70.5 June call, which is trading at $4.30 or 430 cents per contract. Okay. The solution for creating this roll down is we want to create a bull call spread at a lower strike price. So now what we're doing is we're going in, instead of having a straight call option, we're rolling down to a lower strike price, and we're creating a bull call spread. So in this case, we're going to sell our original 75.5 call option, and we're going to get $1.65 for that. So that's what the market value of that option contract is worth, with the stock at with the pair value all the way down at 72.5. Okay, so $1.65. What we're going to do is we're going to sell an additional 75.5 call option, okay, and actually collect a total credit of $3.30. But we have a problem, and that problem is that although we've offset the one position by selling it for $1.65, by selling that second position, we've created a position that's naked in the market. In other words, we have an unmanaged, an unidentified risk exposure by selling that 75.5 call.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.